You just bought a new house. Congratulations. You're excited and eager to move in and start this new chapter in your life. But if you're like most of us, you had to get a loan to help pay for that house. You probably went to a bank and probably got what's known as a 30-year conventional mortgage. And when you were doing that, someone from the bank hopefully told you what your monthly payment for the next 30 years would be. But where did that monthly payment number come from? The bank just tells you the number and you kind of just have to trust it. Welcome to Data Demystified. I'm Jeff Galak, and in this episode, we're going to unpack where that monthly payment for your mortgage comes from. And in doing so, learn about amortization, something that sounds complicated, but is really quite straightforward when you pull back the jargon. If you stick around, I hope that you'll have a much deeper and more intuitive understanding about the way mortgage payments are calculated. So let's jump into this and first say that the monthly payment for your house likely has a few parts to it. If you're like me, your bank probably handles payment for any property taxes and home insurance, but those really have nothing to do with the mortgage payment. You'd be making those payments yourself if you had no mortgage, but the bank does it for you to ensure that these things are all paid up since they have a stake in your house. So, going forward, I'm only going to talk about the part of your monthly payment that's associated with the mortgage itself. This is the part of your payment that goes away once you've paid off your mortgage, and the one that is affected by key things like interest rates and loan duration. Anyway, let's start with the basics. The most common mortgage in the US is a 30-year fixed-rate mortgage. This means that you make monthly payments for 30 years and that the interest rate doesn't change over the course of the loan. But what's the interest rate anyway? Well, basically, the bank gives you a bunch of money to help you buy your new house, but they don't give that to you for free. Instead, they require that you pay them some small amount each month for the next 30 years. That amount is defined by the interest rate. Let's make this concrete with a simple example. Let's imagine that you get a mortgage for $100,000, and the bank says that they'll give that to you if you promise to pay a 5% interest rate for 30 years. This seems straightforward enough. 5% of $100,000 is $5,000, so I guess you pay them $5,000 each year, right? Well, not quite. The first problem is that if you only pay $5,000 each year in interest for 30 years, at the end of that period, you'd still owe the bank the original $100,000 that they lent to you to buy your house. To be sure, there are loans like this, typically called interest-only loans, but they are pretty rare when we're talking about regular people buying homes to live in. So what then do you actually pay each year? Well, you need to pay the bank not just the 5% interest, but you also have to pay them back the $100,000 that you borrowed. So maybe we can just take the $100,000 and divide it by 30 years to get another $3,333.33 per year. If we add that to $5,000 per year in interest, that would get us to a total of $8,333.33 each year. Or, since you're making monthly payments, we can divide that by 12 and get a monthly payment of $694.44. That makes sense, right? Well, actually not quite. If we did the math this way, you'd be way overpaying the bank. But before I explain why that's the case, if you could take a moment to like this video, subscribe to this channel, and click that little bell icon so that you don't miss out on any new content that I put out, I'd really appreciate it. With that said, let's figure out what you really owe each month on that $100,000 mortgage. The reason that a monthly payment of $694.44 is way too much is that every time you make your monthly payment, you're reducing the amount you owe to the bank. And the bank actually only charges interest on what you still owe, not on what you owed at the start of the mortgage. Again, let's make this super concrete. We'll stick with the 30-year mortgage for $100,000 at 5% interest to keep this simple. At the start of the 30 years, you do owe the bank the full amount, $100,000. And 5% interest on that is $5,000 a year, or since we're making monthly payments, $416.67. But let's say that you have some extra cash laying around, and you send the bank a check for $1,000, instead of just the $416.67 in interest that you owe. Well, that extra $583.33 doesn't just disappear. Instead, the bank takes that extra money and subtracts it from what you owe them. So now, instead of owing $100,000 to the bank, you only owe $99,416.67. It's not much less, but it turns out that even that small reduction is a big deal. And the reason is that when next month rolls around, the bank now computes the new interest that you owe them based on this new, smaller total rather than the full $100,000 value of the loan. You still owe 5% interest, but now it's 5% interest on $99,416.67. That works out to $4,970.83 per year, or $414.24 per month. Note that this is now a bit less than you owed in interest last month. Again, this may seem like a tiny difference, but it matters a lot when we repeat this step over and over again. If you kept paying $1,000 each month, a lot more than you owe in terms of interest, you'd actually wind up paying off that $100,000 loan in just under 11 years. You can see that depicted in this chart here. This is a pretty typical chart when it comes to mortgages, so let me walk you through it so you understand all the parts. First, the two lines, when summed together, represent what you'd pay each month. They're split up to show that some of what you paid is for paying the interest you owe, and some of it is for paying back the original amount of the loan. In this example, these two lines always sum to $1,000, since that's what we said you'd pay every month. At first, the interest you owe is on the full amount of the loan, and it is the same $416.67 we saw before. And the amount you pay toward paying down the $100,000 that you owe is the same $583.33 we saw before as well. Note that those two numbers sum to $1,000. But as every month passes, you owe less and less, so the amount you owe in terms of interest goes down. And as that goes down, the amount of the $1,000 payment that goes to pay off the loan itself goes up. We can also add to this chart what you still owe on your loan with these bars here. As you make more and more payments, the amount you owe on the loan goes down until that value reaches zero. At that point, the loan is paid off and you have a mortgage-free house. Okay, this is all well and good, but it still doesn't tell us how the bank comes up with a monthly payment for you. After all, in the example I just walked through, where you pay $1,000 each month, the loan is paid off in just under 11 years, but I thought we said that this was a 30-year loan. What this tells us is that paying $1,000 per month is way more than you need to pay each month if the goal is to pay this loan off in exactly 30 years. So how much should you pay then? Let's try a different amount. What if we only paid $500 each month? This would be more than the interest we owe at the beginning of the loan, so that would mean that the loan would eventually get paid off. Well, in this case, it would take us just about 36 years to pay off our loan, which is longer than the bank agreed to. We can see that in this graph here. Yes, we are paying down the loan, but it is just taking too long. Okay, what about $600 per month? Well, that would actually only take about 24 years to pay off, which is faster than we need to pay the loan back. We again can see that in this chart. Well, what about $525 per month? That would take about 31.5 years. Close, but still too long for the bank's taste. Okay, what about $536.82? Well, it turns out if we make this payment, that will pay off our loan in exactly 30 years. This is the exact amount we need to pay each month to make sure that after 30 years of payments, paying 5% interest on whatever our loan amount remaining is at the end of each month, we'd have a loan balance of exactly zero. That is where the monthly payment comes from. The bank sits down and figures out what the amount you'd have to pay them each month would be to ensure that the loan is paid off in the exact time frame that they agreed to, 30 years in most cases. If the agreed period of a loan is different, like if you had a 15-year loan, well, the monthly payment would change to reflect this. If the interest rate is higher, well, your monthly payment would be higher too. But it all comes down to this single question. What is the minimum you'd have to pay off the loan in no more than 30 years? This is the idea of amortization. It is the ability to determine the amount you'd need to pay each month, given a specific loan duration and a specific fixed interest rate, to pay the bank both the interest you owe them and pay them back for the amount that you borrowed. What this also lets us do is figure out how much you'll pay the bank over the course of the entire loan period. If you're making monthly payments of $536.82, we can multiply that by the 360 months you'd have the loan and find out that you'd pay the bank on your $100,000 loan a total of $193,255.78. Though remember that $100,000 of that is just paying them back for what they lent you in the beginning. The remaining $93,255.78 is what you paid the bank over 30 years in interest. And what's worth pointing out is that if we go way back to our original incorrect calculation of paying the bank 5% or $5,000 each year in interest, that would work out to $150,000 paid in the bank in interest over 30 years, which I hope you now see is way more than you actually have to pay. And if you ever want to figure this out on your own, it's as easy as searching for one of the 1,000 mortgage calculators out there. They all basically do the same thing, so just pick the one that looks best to you. What it'll do is figure out exactly what we worked out here, what your minimum monthly payment will be given a particular loan amount, duration, and interest rate. In the end, what I hope you got from this is a more intuitive understanding of how your mortgage monthly payment is computed. It's not a black box, it's not a mystery. Rather, it's just the minimum you'd need to pay to make sure that you pay back your loan in exactly 30 years. But what else would you like to understand more intuitively? Be it personal finance, investing, statistics, or anything else related to data? Leave a comment below and I'll make sure to make more content meant just for you, my viewers. With that said, as always, thanks so much for watching.